Hello, my name's Paul Cooper and I'm Corporate Reporting Manager at ACCA. I'm joined here by Richard Martin, Head of Corporate Reporting, to talk about the IASB's revisions to its conceptual framework, which forms the basis for the preparation of financial statements. So Richard, could you just please outline to me what is the framework and what you would like to highlight to members with regard to the revisions?
Yeah, the framework is as you've said, the basis for the preparation of accounts, and so its main uses are by the IASB to set standards, and it's mostly to give consistency and coherence to the standards that they're setting. So in changing the framework, we are changing the shape of current and future standards as they develop them. We're at an early stage in the process, so it's a discussion paper of possible concepts and issues that they'll cover in the framework, but it's going to take a bit. This is the beginning of the debate, in other words, and then there'll be further developments later. The other important use of the framework is by when people prepare accounts. In limited circumstances, when there is no IFRS to cover what you want to, the issue that you have as a company or you're faced as an auditor is the other use, and then you can look to the concepts of the framework to determine a suitable accounting treatment to use where you haven't got any other.
And why is the IASB revising the conceptual framework now?
Yeah, the current framework they have was called the Framework for the Preparation and Presentation of Financial Statements, to give it its full title, and it was developed in 1989. And I just think that quite a lot of water's been under the bridge since 1989. We've developed a lot of new standards, and there are a lot of important standards still under development. And so I think there are improvements needed to the framework, and it doesn't always work. The biggest gap was in terms of measurement, and so the framework said very little about, if you have an item, how it ought to be measured.
Right, you mentioned measurement, and I gather that assets and liabilities are having a fundamental rethink during this current phase of the revisions to the conceptual framework. That sounds quite fundamental to the preparation of financial statements. Yeah. Can you just outline to me what's happening with regard to assets and liabilities and the definitions of them?
Yeah, you're right. So the definitions are changing slightly, and obviously the definitions of assets and liabilities are in this framework they're developing, one called the Conceptual framework, that is the new framework. Assets and liabilities are the fundamental building blocks of the accounting system, and everything else is in a way defined in relation to them. So changes, even if they're fairly slight changes to these definitions, can be very significant. The definition of assets is changing. It's changing only slightly in the sense of what there will be any reference to the probability of inflow. So if I give you the new definition that we'll be looking at, is an asset is a present economic resource controlled by the entity as a result of a past event. Resource is a right that is capable of producing economic value. Now, the difference is really in that capable of producing economic value. Up to now, we've had a definition which talks about that inflows of economic value are probable. And so that is setting a definition. Certain assets, if they're too remote, if the probability of economic benefit coming to the entity is too remote, they won't make the definition. With this one, anything which meets those criteria, you have it controlled as a result of a past event, and it's capable of producing economic benefit under whatever circumstances, then it meets the definition, and that's the important bit.
Right. So probability is not so much of an issue now, but measurement seems to be quite an important criterion. Does that affect what goes through, how items are measured, either say at fair value, cash flows, original cost?
Okay. Yeah. I would say the same thing is true of liabilities. All right, that the definitions are very much symmetrical between assets and liabilities, and it's the same sort of change about probability of outflows in this case, it will be the case that certain assets, certain liabilities also may currently not meet the definition. Contingent liabilities, for example, which are a disclosure item only, but under this definition could be included as liabilities that you recognise on the balance sheet. You were talking about measurement. This is where the effect of probabilities of how likely or how unlikely inflows or outflows are to take place, and this is where that will be reflected. So there'll be assets, for example, in the case of assets with a low probability of inflow, then they're going to be recognised as assets, but you might measure them at very little because the probability of the incoming benefits are small.
Right.
We want to go, but you were also talking about historical cost and fair value, weren't you?
That's right. Whether this current revision process affects the decision as to whether to measure at fair value, historical cost, or some cash flow measurement.
Yeah, and that's right. And I think I have said that's one of the current big gaps in the framework, that we've got a lack of measurement guidance as to where that's at. So that's the other. I think one of the other big topics in this is this question, and people have generally, I found, felt pretty strongly about this issue. A lot of people have been very unhappy about the move away from historical costs towards fair value, and so they've been looking very keenly for the developments that are coming in this framework to point the way. Is the ISB going for all full fair value models, or is it going for is it going for a sort of mixture or whatever? What it's saying is that in future they will make the choice between a cost-based measure, a measure based on market prices, which for fair value. They will make, and indeed a third basis, which is, as you said, the cash flow basis. They will make that on looking at an individual standard. They will look at how the assets are likely to be realised. So, are you more likely to sell them, or are you more likely to hold them and realise them in their value in some other way in your business? What is the value of the information that is going to come out?